Hi guys, it's Chad Larson with MLD Wealth Management and Canaccord Genuity. I'm joined here again today by Travis Robinson, the S&P Dow Jones Indices. Travis and I filmed one of these before as we continue to try to develop content for our client families that we deal with and others that have been following along and learning a little bit about what MLD is, what MLD does, and how we help client families that we work with. Our last segment was on low vol indexing, and it's a pleasure to have Travis here today as we discuss just some of the other things that we're able to do with working with such quality external partners. But understanding today is going to be really we're going to play Mythbusters a little bit. MLD Wealth is a significant shareholder of ESG Indexing that S&P Dow Jones Global helped put together with Invesco through an ETF. Coming from Alberta, ESG is, it's kind of like a four-letter word sometimes. Obviously, we're in an oil economy and everyone is on this pivot. And when I originally thought of what ESG investing was, it was something that I was interested in more so what one of the acronyms and misnomers is people on Wall Street, Bay Street sometimes call it a snowflake trade, as we try to invest to do good and we don't want evil polluters, or we don't want certain segments of the economy. And it was more about being in front of where capital flows were coming. There's some timely things, even as live as today, that have happened that we'll touch on. But really, here to demystify, and Travis is going to kind of walk us through, what ESG investing is and from our perspective, what we're here to talk to today, from the margins into the mainstream. So, Travis, thanks for being here today, and I'll pass it over to you to walk us through the presentation we made today.
You bet. Thanks for having me, Chad. And you mentioned ESG as being a bit of a four-letter word in some circles, and I'm down here in Colorado, which I think affectionately of as Alberta's little brother. Big oil and gas communities down here, and it's an important part of our economy. And I think as indexing has evolved, as the tools and the technology and the capabilities around calculating ESG scores have evolved, we're now able to incorporate ESG, but not divest from entire sectors or industries. So I can get into a bit of that in a few minutes, but it's a big component of what makes our approach mainstream. And I think valuable for those that do want to have the conversation, would like to have an impact with their capital or incorporate it into their investment strategy. There are the tools there. There's the data and the ability to incorporate it and not make the sacrifices that historically came with divesting or socially responsible investing. So here in the second slide, if I can get it to come up, like you said, Chad, a bit of myth busting. I've been in the industry for 20 plus years, and early in my career, I worked with a portfolio manager who built portfolios around socially responsible investing. So they would screen out stocks depending on the values. If you didn't want to own tobacco or Catholic values, you could screen down a portfolio, but it was exclusionary. And the challenge with that is when you start excluding a lot of securities, you then get away from the core of U.S. equities. And a lot of times that meant underperformance relative to your benchmark. And of course, the S&P 500 represents 80% of the U.S. economy, about a third of the global, 80% of the U.S. market, about a third of the global equity market. So just in that one index, it's a big swath of exposure to stocks. And if you get significantly away from that exposure and you're underperforming, it's tough to stay invested and stick with a strategy. Now, as I said, with the tools that we have and the technology to go out and survey thousands of companies and calculate an ESG score every year, we're now able to build indices that look like those big core benchmarks like the 500 or the TSX composite. We're able to build those benchmarks, but incorporate a lens of ESG to then tilt the portfolio towards better stewardship, better ESG scores
Yeah, and
with
you mentioned, to look like, and I think we'll get into it, and I'm doing some foreshadowing. Not only have we kind of been able to construct something that looks like it, but we're going to get into kind of some of the meats and bones in slides 4 and 5, and to act like it as well, because the sacrifice of performance versus uh, individuals' unique value systems is one that's really challenging to implement, because inherently greed is still part of what we do as we seek to invest our capital and grow it over market cycles to meet long-term goals. So
Yep. Yeah, and that's the kind of the heart of it. The way we approach ESG and our core ESG suite, and S&P Dow Jones Indices has a broad lineup of ESG options and indices, but this core suite that we've built really is designed to replicate the headline benchmark. So what you can see here is the 10-year performance of the S&P 500 overlaid with the 10-year performance of the 500 ESG index. There are two different lines there. If you look closely, you can see there's a lighter green and a dark black or dark green line in there. So there are two distinct lines. But when you aim to replicate through capturing, this is a bit too detailed, so I'd be happy to get into it directly with anybody that wants to do a deep dive on how the index is built. But when you're sampling the index and replicating it industry by industry, with a target error, tracking error of 1%, you get the performance of the 500 plus or minus 1% during various periods. Now that's our target. It could be greater or less than that. But again, the end goal is to provide as much exposure to the 500 as possible, but then improve the overall ESG score. So you see in the bottom of that table there, the ESG improvement is 21% when we apply this methodology and we go through and build the index in this way.
Right.
Looking at I don't have it in this chart pack, but the 1-year number, I can skip to it. Looking at the 1-year number, again, very similar experience. In fact, there's a bit of outperformance just because of the exposure you have in the ESG that's tilted towards large cap, mega cap, and towards technology.
Yeah, and we'll reference that briefly. I know we were reshuffling the deck just prior to this call to make our movie magic. But within the 1 year, and we never want to fixate on one select period of time, but here we are living through arguably the most, well, not mathematically, the most volatile market we've seen since we've been recording history. And the 1 year number has year to date has outperformed that of the general, and that's because of the inclusion of some of the sectors or exclusion to a lesser degree. Because people in times like this do want to know how are we doing today, and happy to report that we're outperforming, I guess, what our benchmark would be that we're seeking to replicate.
Yep. And unfortunately, trying to jump to the 1 year number, I lost the slides and it won't let me put them back up right now. But again, if you're able to do it on your end, go ahead, Chad. But otherwise, I mean, really, in conclusion, what we're doing here is taking a very robust process of scoring companies, individual company by individual company, industry by industry. There are 24 industries, 11 GIC sectors. We're going through and building out this index. There we go. There's the pyramid. We have up to 1,000 data points we collect on each company. We not only go out and gather the publicly filed information, which is what most ESG data providers do, is just simply scrape the publicly filed information related to ESG metrics and then create a score. We go a lot further than that, in that we're also surveying each of those companies, as many as we can get to return that survey, which is, an industry leader, thousands of companies coming back to us with that survey, or 1,000 plus companies coming back to us with that survey. And we then take the survey, the public data, combine them for an ESG score. Again, scoring each company on an industry specific basis, right? So if you're a materials company, you're being compared to other materials companies, right? Mm-hmm. The way you handle your waste is much more important than the way you handle data but it's vice versa for Facebook and other technology companies or communication services companies. So industry by industry, we're going through and analyzing the companies and ranking the group, ranking each company within their peer group. And that's how we isolate, the best of those companies and the worst offenders. And we're going to allocate capital to those with good ESG scores. And then, of course, by not allocating the others, hopefully there's some incentive for them to improve their scores around the ES and G.
Yeah, that's a good point. And just to reframe it, just to drive it home, not that your explanation wasn't robust, is that we're not excluding certain sectors to not capture that wide breadth of the U.S. economy. But if we've got 10 constituents that make up the bulk of a single subsector, we're going to highlight and include those that are performing relative better to these metrics. So if they're maybe if you could give us an example, you talked materials and technology would be one, is if we've got 10 people trying to show up to the party, we're going to make sure that the 8 that are best groomed and got their invitations and brought a host gift, or they're going to get into the party first. Is that fair?
Yeah, that's fair. And it's interesting, this year, Facebook has been added back into the index, but they're a great example. A lot of issues, as we all know, for Facebook around data, privacy, and the issues that they were dealing with over the last couple of years. So they fell out of the index in 2019. And it's interesting that, you think the 500 ESG index has been around for a few years. It's not necessarily what is on every board's mind yet, but when Facebook falls out of the S&P 500 ESG index, it hit all the media outlets, right? And there's accountability there at the board level, most likely, for a company to say, why aren't we included? Why are we scoring so low relative to our peers that we're no longer a part of it? And I certainly don't know what conversations they had at Facebook, but that's what we're trying to create, right? Some accountability, some visibility into who scores well, who doesn't, and are they included in the 500 ESG index?
Absolutely. And as much as this has gotten attention, the media from an investor interest standpoint, speaking with many clients and many CEOs that I know, the discussion in and around ESG, even indirectly impacting parts of their KPI, health and wellness and safety of workers, and all of these things are happening at the board level to be more inclusionary and well-rounded, to be good corporate citizens. So it's that next evolvement of board level KPIs, which is driving performance of their equities as well.
Yep. And that's our intent, right? Just, again, more transparency, more for the, metrics that are, if we measure it, hopefully it gives them something to improve, right? And so in a way, the goal here is to have your cake and eat it, right? To improve the overall ESG score and the impact companies are having. But also to give yourself a core exposure and not end up with a very different return pattern than the S&P 500, which is so important to most investors' portfolios.
Yeah. And also I think that's pretty well rounded. There's so much more that goes into the creation of this, and I didn't want to bog listeners, viewers with some of the methodologies and deeper. And so I'll challenge all of you, if you'd like to go deeper into some of these discussions, reach out to myself, and via Travis, we'll deliver some more deeper data to you. And I just wanted to scroll through the obligatory performance and disclaimers that are important in doing all of this as we continue to develop content. But again, Travis, thanks so much for being here today. And I know our viewers are enjoying these, and we'll look forward to speaking with you again soon.
I enjoyed it. Thank you for having me, Chad. Take care.
Cheers.